Another accounting item you definitely need to know about is T accounts. And what is a T account? Well, it's an account that tracks all the additions and subtractions to a particular account over a period of time and determines the account's current balance. So each unique aspect, each item of your business is going to have its own account, and that is the T. And in that T, you are going to track all the things that happen within that particular account during the period, and then find out at the bottom what the current balance of that account is. So let's take cash, for example. Additions and subtractions. What would we have as an addition for cash? We would have cash taken in by the business, probably for providing a service or making sales, etc. The T account is also going to keep track of what we spent cash on. What was our outflow of cash? How much cash went out of the business? And then the balance is what we currently have in the bank. You can learn all of these from a T account. Accounts payable, that is money that our company owes to any other party. So having to pay our utility bill, having to pay for supplies that we purchased, having to pay for office equipment that we purchased. All of those things, when we owe money, it's going to go into accounts payable. What would the accounts payable T show? It would show what transactions we made that caused the company to owe money. Essentially, what things happened that caused our debt to increase. Subtractions. What debts did we pay off? What payables did we get rid of because we paid them off in cash? And the balance of an accounts payable T account will show you what amount of money your company currently owes to third parties for all of the normal purchases a business makes during a period. T account looks as such. Across the top you have the account name. Doesn't matter what it is, cash, supplies, equipment, etc. The left side is the debit and the right side is the credit, because debit means left and credit means right. To find the balance of a T account, you need to first figure out what type of account it is. So what type of account? Our example is cash. What type of account is cash? Cash is an asset account. Well, from there we need to know how assets work. And as we know at this point, assets always increase with a debit and decrease with a credit. So to find a balance to this particular T account, you add everything in the T account on the side that account increases on, the debit side, and you subtract out everything that's on the side that the account decreases on, which is the credit side. So if we add together all of our debits to cash and subtract out credits, we're going to find the balance. So what we're saying here is the company began with $4,000 in cash. We took in $2,000 on January 8th, we took in $1,000 on January 18th, and we took in $4,000 on January 25th, but we paid out $1,000 on January 31st. So at the end of this month, we should have $10,000 in our bank account. How does it work? How did those numbers get in there? Well, let's take a journal entry, for example. On January 1st, Freshen Up Soda purchased a $5,000 piece of equipment, and they did so on account, so they didn't pay for it in cash. They still owe money for this piece of equipment that they're purchasing. What would the journal entry be for this? Two things being affected are equipment, because we're buying equipment, so the value of our company's equipment has to change. Accounts payable, we're going to owe more money in this case. What goes where? Well, equipment is an asset, and assets always go up with a debit. Our total amount of equipment that our business owns is going to go up because we just bought some, so we're going to debit equipment for $5,000. Accounts payable is a liability. All liabilities go up with a credit, and our liabilities are going up because our company is going to owe more money to third parties because we just made this purchase of equipment. So we debited equipment for $5,000. We credited accounts payable for $5,000. We simply take those numbers right from the journal entry and we put them in the T. Since we debited equipment for $5,000, we're going to throw that $5,000 into our equipment T, assuming we had a beginning balance of 0. It means the current balance of our equipment is $5,000. Accounts payable, we had a beginning balance of 0, but in this journal entry we credited it for $5,000. Well, let's go and throw the $5,000 into the T from the credit from our journal entry right into the credit side of our T account, bringing our balance of accounts payable up to $5,000. Let's give a little bit more detailed example of how this works during a period. So we have ABC Company, and they had 3 transactions. We'll keep this short during the period. On the 1st, they purchased $4,000 worth of supplies on account. On the 15th, they paid $3,000 of that debt off. And on the 30th, they purchased an additional $1,500 worth of supplies on account. Well, let's make the journal entry for each of these. Start with March 1st. we're purchasing supplies. So the value of our company's supplies has to be going up because we're getting more supplies. Well, supplies are an asset, and all assets increase with a debit, so we know we're going to have to debit supplies for $4,000. Accounts payable is a liability. We're going to owe more money to other people because we just made this purchase of $4,000 worth of supplies that we still have to pay for. Liabilities go up with a credit, so we're going to credit accounts payable for $4,000. And after we do, we're going to go and we're going to move those numbers right into the T account. So let's take the debit of $4,000 from March 1st and put it into our T account. We began the period with a beginning balance in supplies of $1,000. We just bought $4,000 more. What do we have for supplies? We have those two numbers added together. We have $5,000 in supplies. We began the period not owing anything in accounts payable, but we just took on a debt of $4,000 by crediting accounts payable for $4,000. So let's credit accounts payable in the T account as well, meaning that our balance is $4,000. The total amount of money we owe to third parties is $4,000 right now. On March 15th, we're going to make another journal entry. And in this case, we're paying off $3,000 of that debt, which means our liability, the amount of money we owe people, is going to go down. Well, liabilities always decrease with a debit, so we know we need to debit accounts payable for the amount that we are paying off, and it's $3,000. What are we going to have to get rid of? If we're paying off a debt, we're going to have to get rid of cash. So we're going to credit cash because cash is an asset. Assets decrease with a credit. We're going to credit cash for $3,000 to pay off this account, and then we're going to move those numbers directly from the journal entry into the T account. So accounts payable got debited for $3,000. We're going to debit in the T accounts. Again, for all T accounts, you add the side that it increases on and subtract the side that it decreases on. Accounts payable is a liability. It goes up with a credit, down with a debit. So we add all of our credits together, subtract out our debits, and we get a new balance, which common sense will tell you if we owed $4,000 and we just paid off $3,000, what do we still owe? We owe $1,000. That is our balance to accounts payable. For cash, we credited it for $3,000 in the journal entry. Let's move that over to the T. We began the period with $10,000 in cash, but we just sent $3,000 out to pay off the supplies that we purchased earlier. How much cash do we have remaining? We've got $7,000 in cash, $10,000 minus $3,000. And lastly, on the 30th, we're going to make a purchase of $1,500 worth of supplies, once again on account. Well, this is the same exact entry we had on March 1st. It is a debit of supplies for $1,500, a credit to accounts payable for $1,500. So we move that into the T accounts from the journal entries. We debited supplies for $1,500 on March 30th, which is going to change our balance. We had $1,000 to start the period. We bought $4,000, bringing us up to $5,000, but we just bought an additional $1,500, so our balance is no longer $5,000. We now have $6,500 worth of supplies on our company's books. Accounts payable, we credited in the journal entry, move that over to the T account. $1,500 got added to accounts payable. We know before we owed $1,000, so what do we owe in total now? Now we've added on another extra $1,500 for more supplies. We owe $2,500, which again you can find by taking the amount on the side that account increases on and subtracting out the amount that's on the side that account decreases on. 0 plus 4,000 plus 1,500 is 5,500, but we paid off $3,000, which means we still owe $2,500 right now.